Gopal Balachandran joins us, Chief Financial Officer with ICICI Lombard. He joins us to talk about his quarterly numbers and the way forward. Gopal, good morning. Thank you for joining us. Now, you mentioned earlier that the COR will remain in downward trajectory, and for FY25, the COR declined by 50 bips. But for Q4, it is similar to Q3 FY25. This quarter, we see higher claims ratio. What led to this?
I think the only point that I would make is there has been a regulatory change that happened in the middle of the year in the current financial period. And to that extent, the numbers for FY25 may not be necessarily strictly comparable with the FY24 numbers. Having said that, specifically to your point on the Q4 combined ratios, as what you would have seen, the reported combined for Q4 this year was 102.5, vis-a-vis, let's say, 102.3. But if I adjust for the change that I talked about, which happened in the middle of the year, my 102.5 would have otherwise looked at 102.1. So even if you look at on a sequential basis, in terms of Q4 of last year to Q4 of the current year, adjusted for the change that the guidelines had come into force, we have actually seen some improvement in the overall combined as well. But as we keep saying, the direction that we will take from here on, to your point on how do we see possibly FY, I think we will continue to stay focused in terms of our approach to writing profitable book, and hence logically we should expect an improvement in our combined ratios even going ahead. And at the same time, as we have said, the larger objective that we will keep driving for is to try and see how we can better the return on equity that we are able to give to our shareholders. So that's what we will primarily focus on.
Right. You also guided for an ROE of about 16 to 20%. FY25 ROE is already at about 19%. What factors do you think are going to help you maintain and remain in this range? Because specifically in Q4, we saw a dip in your ROAs below 15%.
Yeah, so inherently, if you look at our business, obviously is a lot more cyclical. And when I say cyclical, a lot of, so if you look at our revenue streams, we generate profits through the core insurance business. But at the same time, given the fact that there is also a lag between the time we collect premium and there is a various outflows that we have in terms of reinsurance, acquisition cost, operating expenses, claims, etc., etc. So we also do have an investment book through which we also generate a reasonable return on the investment portfolio. Now there, depending on how the market conditions plays out, is where you will see opportunities playing out for us in terms of there being any capital gains in a particular quarter or not. Specifically to your point on this Q4, return on equity is at maybe at a slightly lower level than, let's say, on a full year basis. Again, we will keep urging everyone to keep looking at the numbers more on an annual basis, because that's more partly reflective of how do we see things playing out. But specifically on the point of Q4, which is what we kind of explained on the earnings call that we had yesterday as well, to say that Q4 of last year, we had a capital gains of roughly about 150 crores plus. If you look at the current Q4, depending on how we saw the markets play out, the capital gains was hardly a very, very nominal number. And therefore, that definitely tends to have an impact insofar as the return on equity for Q4 is concerned. But this has to be again looked at in the context of Q3, for example. Q3 of the previous year had a capital gain of roughly about 110 or 115 crores, whereas Q3 of this year, we had a capital gain of almost about 275 crores. So that's how we look at the market opportunity, wherever we see the markets in our favor. So to that extent, basis the treasury call, we will be able to kind of get some gains.
All right, but Mr. Balachandran, we have also seen your investment income declining in the quarter gone by. Help us understand how should one expect the investment income trajectory in the coming quarters given the recent rate cut?
Let me kind of first respond it in the context of from a short-term perspective. I think if you look at specifically on the point that you had on the bond side, we actually kind of leveraged the opportunity which the market had presented in the last couple of years, consequent to the high interest rate regime, and we actually kind of leveraged that potential to expand the duration of the portfolio that we were able to kind of write at. Just to kind of refresh, at the end of March 22, our duration of the portfolio on the bond side was slightly less than 4 years. Today, as you speak, as at March 25, that duration of the book has increased to almost 5.34 years. So clearly, we have been able to go long, and that's the reason why our yield to maturity of the book, which used to be maybe a couple of years back at less than 7%, today the yield to maturity of the portfolio is running at 7.55%. So clearly, we have been able to leverage the opportunity that the market had presented insofar as the high interest rate regime is concerned over the last couple of years. And rightfully so, the portfolio today, if you were to see in the context of maybe the point that you made with respect to rate cut cycle, that's again kind of playing out to our advantage. So for example, if you see at March 31, there is a lot of unrealized gains that's sitting on the bond book. So obviously we will wait for how much more rate cuts happen in the future. But now coming to my longer term point, I think if you look at it from an ICICI Lombard standpoint, historically, if you look at our last 24 years of our existence, on the entire investment book, we have been able to generate a realized return anywhere between 8 to 9%. That's the kind of return that we've exhibited over the last 24 years. In terms of how things could play out, obviously will be a function of what rate environment prevails.
Oops, sorry. So even during our last conversation, you mentioned about the need of price hike. How much price hike you've taken and how much more is expected?
Yeah, so let me kind of talk this in the context of maybe the commercial lines first. Now, commercial lines business is the one that we exhibit so far as largely corporates are concerned. And there, if you see at the beginning of this year, we are called out to say that the market could get a bit more competitive on price. And that's clearly evident if you look at the outcome that has played out specifically in one of the largest segments of commercial lines, which is fire insurance. On a full year basis, the segment has actually shown a degrowth for the overall market. And that's the reason if you would have seen the growth of fire insurance for the industry as a whole has been significantly subdued at slightly very, very low single digit number insofar as the market is concerned. But the good news is what we had talked about in the January earnings call, as in to say that these are segments which are high on exposure and the ability of the market to continue to see competitive pricing for a very long period of time possibly may not be sustainable. And we did indicate that there are early signs of price action come back when we had seen some of the January 1 renewals that the corporates did for us in Q4. So hence we were able to kind of clearly seize the opportunity, and vis-a-vis the market, which still had a degrowth, we kind of grew positively. So our brand, service, and technology clearly came into our existence, and we were able to kind of grow faster at the time when the market pricing started to see an improvement. The same trend continues, which also we spoke in the call that we had last evening, as in to say that pretty much majority of the corporates have their renewal cycles on April 1. And there again, we have seen pretty much for a very large portion of the commercial lines business, we have seen a positive price action. And therefore, to that extent, that clearly augurs very well insofar as the pricing environment is concerned.
Right. Thank you so much for joining us today and highlighting how your earnings, of course, and visibility going forward is. We'll take.
If you like this video, then like, share and subscribe to ET Now.